Hey guys, it's MJ, the Student Actuary, and in this video I want to give a very quick overview of the investment world. So basically it all comes down to the public, and the public are people like you and me, your neighbors, the postman, all of us. And essentially we have two big demands. We have a demand for savings, we want a savings products, and we want some sort of risk protection. So savings would be, setting aside some money today in order for a future expense, whether it be your child's education, buying a new car, buying a house, something like that. Even going on holiday, these are all various cases of savings. Risk protection is anything from insuring your car to insuring your life in case you die and someone having to take care of your kids, all those type of things. So the public has got these two needs, risk protection and savings. And they found that by combining together, they can create certain products. And when they combine together and someone creates a product, an institution is formed. So I want to come look at the 6 institutions that get formed when people group together. Basically, and you can see the red ones cover risk protection, the blue ones cover savings, and the purple ones have a little bit of a savings component and a little bit of a risk protection. Now, there are 6 types of institutional investments, 6 types of institutional investors, just like there are 6 fellowships that you can do your actuarial science in. You can be an actuary in general insurance, you can be an actuary in medical aid schemes, you can be an actuary in life insurance, you can be an actuary in pensions, you can be an actuary in finance, and you can even now be an actuary in banking. Well, this is only in South Africa, but it is going to become available throughout the world in later times. But what happens is the public will go to someone like a financial advisor who will then point them in the right direction for which institution they should give their money to. Like I said, general insurer, you give them money. If you crash your car, they give you money back. Medical aid scheme, you give them money, you get sick, they give you money back. Life insurer, you give them money, you die, and they give you money back. Pension fund, you give them money, and then when you get old, they give you money back. And I think banks and collective investments kind of speak for themselves. But then what happens is that investment consultants, and this is where actuaries can play quite a big role, they will come to these institutional investors and help them explain where they should put their money. Essentially what they will do is they'll give their money to certain funds, and funds are run by asset managers. Now, asset managers are people who have like a CFA or a degree in finance or something like that. And the most common funds are hedge funds, quant funds. Quant funds is when it's a fund that's based on statistical formulas to try and extract anomalies and get a little bit extra alpha. Then there's balanced funds, specialist funds, funds of funds, index funds. And then these asset managers go to the actual market. So they'll go to the bond market, they'll go to the equity markets, property market, and so forth. Now, and that's where they'll deal with brokers. In this video, I'm not going to talk too much about the documents, but if you study actuarial science, you'll go into a lot of detail into what these documents actually are. But if we zoom out, and you can see this is very, there still is the regulator who I haven't spoken about, and he comes and, makes everything complicated and weird. His main goal is to protect the public from the asset managers, but we'll talk about that in another video. Interesting things to point out is your general insurers and your banks, because they're quite short term, they're going to be putting a lot of their money directly into the money market. Whereas your other funds who help other institutional investors who have more of a longer term liabilities, they're going to invest in more longer term assets such as bonds, equities, properties. And I think that basically is how investments work. Is you have the public, they speak to their financial advisor, they give their money to an institutional investor who gives them a product or a promise that then creates a liability. They then contact an asset manager to invest that money in such a way that best matches the assets to their liabilities. But now look, as the public, you can go, the public can be like, screw that, I'm going to go straight here and invest with the asset managers, or you can actually go and invest in bond markets and equity yourself. But it is by going through an institution that you're getting the benefit of people joining together. Specifically when it comes to risk management, when people join together, uncertainty does decrease, and by joining together with certain investments, they can access bigger funds. Because remember, a big pension fund can get a much lower fee from an asset manager when they come with, say, $1 billion than you as an individual who comes with, your little $1 million. So there is those advantages. But essentially, I want this video to be very quick, very short. I wanted to give you guys just a very quick overview of how the investment market works. And there we go. There it is in a picture. Hope you guys enjoyed this video. And if you have any questions,
download the free Aura mobile application now.